This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Today on the show, I have Cullen Roche. Cullen is the founder of Orcam Financial Group, financial services company based out of San Diego. He also, his claim to fame, his hard work, his big effort, pragcap.com, Pragmatic Capitalism. Very well-known blog, tens of thousands, maybe more, readers every day. He's got quite the following. And his new book, Pragmatic Capitalism, is out now. We discuss all of this today. The word pragmatic. I don't know, maybe I can learn something. I need to be a little more pragmatic. I hope you enjoy. Hey, Cullen, how are you?
I'm good. How's it going?
Not too bad. Bright and early in Asia.
Yeah? How are things over there?
No complaints. You know, it's a nice change of pace. You've been to this part of the world.
Yeah, I was in Thailand, I don't know, probably a year ago. We actually just missed each other there. I totally forgot about that.
That is true. We might have been in Bangkok at the same time. But that's being in Bangkok at the same time could be like being in another country at the same time. It's so big.
Right? It's such a huge place.
Yeah.
Is the audio all right on this?
Yeah, you're fine. You're fine.
Oh, perfect.
I was just thinking of all the ways I could torture you today.
Yeah. Well, there's plenty of topics, so...
Hey, listen, let me jump right in. So one of my first things that I wanted to talk about, which is tangential to the new book out and everything, but just the idea of being an entrepreneur, because ultimately you were a guy, yes, you knew something, but you had to take the entrepreneurial step to go out there, put yourself out there, have the audience judge you. And this is long before your book has now come out. We're talking, your blog first went out when?
Started writing it during the financial crisis, so just about late 2008, late 2008.
Late 2008. So you had to take the step to put yourself out there with not necessarily knowing what was going to happen. I'm guessing also with the way your blog posts go, and even though a book has just come out now, typical book might be 80,000 words. How many books have you already written?
Oh man. I mean, I've literally probably written 15,000 or published 15,000 blog posts. So, I mean, I obviously don't write everything that goes on to PragCap. I've probably personally written at least half of those. So yeah, I've written just a huge amount of content, which was a really strange thing for me. I mean, becoming a writer was very foreign. I mean, I was not a good writer in high school or college. Never got good grades in any sort of English classes or anything. And obviously, writing about economics and finance isn't like creative writing or anything like that, but it was still very foreign to me. So yeah, I mean, adopting this whole sort of new talent was a pretty big transition for me. And starting the website, I think, was especially difficult because you see brief glimpses of hope or glimmers of hope when you're starting a website like that, where you'll have an article that gains a lot of traction or something and you get, a lot of good feedback from people. Maybe it gets picked up by a big media outlet and you start generating some attention but it takes a huge amount of time and effort to make something like that become sustainable and really build a name. And, that was always my sort of approach, was my view on really trying to get my name out there was always based on, okay, if I can sort of prove through my analysis and the way that I'm, sort of educating people and trying to teach something, that I can prove to people that I have something to offer. And that was really my the way that I approached all of this. I think that kind of going back to what you were saying about being an entrepreneur, I think that one of the biggest lessons I hope people take away from the book is that when you think of investing, we often think of investing as being something that's done through other people. We think of it as buying someone else's company or buying a stock that is really made up of other people's goods and services and their output. And really, I wanted to sort of reposition people to think of investing as being something that's primarily done through yourself, that the best investment you'll likely ever make will always be in yourself. And I think that my path to really writing this book has been sort of a lesson in investing in yourself and building yourself through education and learning from mistakes. I mean, a lot of the book is about, understanding how we are sort of flawed and we make mistakes along the way, but these can become huge lessons that become, stepping stones to progress and becoming better people and more informed and really building ourselves into something that is more valuable to other people at the end of the day.
It's funny. So you mentioned that path, but I laughed to myself. It's very similar to kind of what I was doing in the sense, but a few years before you, but it was like, okay, I know something. I want to get it out there. All I have is a blog, and let's see if I can do it well enough for people to respect it and for it to gain traction. And I think both of our experiences, and getting back to your point about investing in yourself, both of our experiences, not that we're anything, look, we're just guys, we just do our thing. But, for anybody that's sitting out there and saying, oh, I can't do it, I don't have any opportunity, look, if you can make a blog, then you've got opportunity, you can do it. And the only excuse is you.
Yeah. I'm a guy who is probably of, I don't know, moderately above average intelligence. And, I don't have any incredible talents or anything. I sort of am okay at lots of different things. I'm probably fairly good at understanding, the big picture to some degree and sort of piecing together the puzzle. But I don't have any incredible, unique talents or anything. I think I'm a fairly curious person who has a pretty good work ethic, who becomes probably a little OCD about some things in terms of when I really want to try to understand something, I have this sort of unquenchable desire to figure it out. But that's all about effort, I think. And the website that I built and in the book ultimately, I think is just about the effort that I put into really learning these concepts and developing, I think, a framework for sort of understanding things and thinking of the world of finance and economics in a particular way. And
working hard has got to be the secret. That's your secret sauce, though, working hard consistently.
Yeah, working a lot. I mean, I don't know. It's interesting because I don't know. I mean, I was going to say, I sort of copied guys like, God, I read your blog for years before I ever started one. I read Barry Ritholtz's blog for years before I ever started one. And I finally sort of got to the point where, I would talk to people about things and I said, I can be that guy who has a message to tell people. Mm. And it might not be very valuable, but somebody might find it valuable. And as time went on, I learned just so much from, the beauty of writing a blog is that it's not only very cathartic in that you're putting yourself out there and you're very vulnerable, but if you're willing to take a little bit of even abuse from people and criticism and think of it in really a constructive way, it can be an incredibly positive way to get feedback from people and to really learn and educate yourself. You're not just spreading a message to everybody else, but you're really absorbing feedback from the way that you're describing your message. And so writing is just a very, I think, almost a soothing and cathartic way to interact with people.
But you have to jump, right? You had to jump. Before you could even build that feedback loop, you had to jump off the cliff.
Yeah, you've got to be willing to take the risk of, the biggest problem with writing, especially early on before you're generating any sort of, page views or audience or advertising revenue or any of the intangible benefits that come from having an audience, is it's very hard to get to that point where it becomes worth it, and my girlfriend at the time was always saying, now fiance, she was always busting my chops over it, saying, what are you doing on this stupid website that is generating no money for you and taking you nowhere? And, I had seen some of the intangible benefits of writing and meeting people, and it's a great networking source and just lots of other little intangible benefits of taking that risk. But it was hard for a long time. I mean, it was a lot of time that seemed like a sunk cost for a lot of the effort. And so
let me throw out what one potential reason. This is kind of the one way that I've looked at it, is that once you saw, by putting a blog out there, putting writing out there, getting the feedback, you knew deep in your gut. You didn't know how it was going to unfold, but you knew deep in your gut that you, Cullen Roche, could be a media, I don't want to say conglomerate, but you could be a media operation not unlike Bloomberg. You didn't know when it was going to unfold or how it was going to unfold, but if you could get traction, you can get followers, you can get people that like your stuff, you can get that feedback loop going, that the internet had created something, it created an opportunity that never had existed for guys like me and you before.
Yeah, well, it was sort of, to some degree, it was lucky timing when I started my website. I mean, given my background and stuff, because I had done so much work on understanding sort of the monetary system and at least some economics at that point, where I was able to sort of traverse two different worlds that I think that are in finance and just the world of markets in general. The field of finance and economics are they're very divergent. I mean, you don't see a lot of overlap in terms of, if you look at the big investment banks, for instance, the economic guys, you have your chief economists and all, the people that sort of work for them. And then you have their trading departments, and they're very fragmented. I mean, they're not the same operation, and they don't have a whole lot of interaction. And what I realized in 2008, 2009 was that the economics of what was going on at the Federal Reserve and what the government was doing and what was happening to the economy seemed to matter more to the markets than it ever did. And so I started to really realize that there was a message there, and people were really hungry to understand what was going on. And, I certainly didn't have all the answers, but I felt like I was in a unique position where I could provide something of value to people that wasn't being provided by a lot of the mainstream media sources like CNBC or Bloomberg or anybody. And so, yeah, I think that was the risk that I was willing to take. I thought to myself, I have something to offer, and, I can make that available to people in a free medium that ultimately will hopefully come back and benefit me in some other intangible way.
Okay, let's jump in. Not that we have already jumped in, but let's jump in. So the big word that has been a big part of your career, and I want you to explain why you chose it and what it means. And I don't really think a lot of people use this word, pragmatic. People don't use this word. So why has pragmatic become a word that's been central to your universe for the last 5, 6, 7 years?
Well, I think, again, kind of going back to a lot of the mistakes that I've made in my life, I think that if there's one thing that I'm probably fairly good at, it is identifying when I make an error and trying to resolve it so that I don't make the same mistake again in the future. And I think one thing that I learned very early on dealing with just sort of trading in the markets in general was that I was very biased by my own personal opinions and my political views, and I realized that was somewhat destructive at times, that I was so biased in some ways that it was really hurting my performance, and that I realized that by taking sort of a step back and trying to think of things more objectively and from a more practical perspective, a more pragmatic perspective, that I could actually improve my performance by eliminating some of these biases and a lot of the things that I think lead people astray in the way that they not only understand things, but the way that they then try to benefit from them in terms of implementing a market strategy or something like that. So trying to build a more pragmatic framework was really essential to the way that I began to implement investment strategies and working with clients and things like that, because it allowed me to really focus on what makes things work rather than trying to so much of the political world is trying to take what's broken and fix it. And when you start thinking of the financial world and the investment markets as they should be and not as they are, you end up, I think, confusing a lot of things, and you start almost relying on a hopeful strategy rather than one that's grounded in reality. And so that was really the reason why I focused on trying to build sort of a pragmatic framework, was because I realized from my own mistakes how just destructive they can be.
So we can cover, as we talked in email, a lot of topics today, and I want to give people a flavor for where you go. The book is very detailed, a lot of different topic areas. It's cohesive, but there's places you can pull from and have discussions about. And that's kind of what I wanted to do today, was just to touch on some areas and bounce around with you and let you kind of explain to people your perspective. One of the first things I wanted to start with are some of the myths that you love to get at. And some people might immediately think, oh, I know where he's going with this, da-da-da-da-da. But the way you do it does require people to sit back and think. For example, the U.S. is going bankrupt. Now, there are definitely people out there from a political standpoint or even an economic standpoint, and they want to say that. But you make the case for several reasons why technically that's just not going to happen. If you want to argue it politically, fine, but it's not accurate. The U.S. is not going bankrupt, is it?
No, and I think that, again, you kind of get into a lot of the politics of this stuff, and I think that it's very convenient, I think, to think of the U.S. government's balance sheet just like a household balance sheet. And the problem with thinking in those terms is that the government really, it doesn't operate like a household in any way. The government is not a profit generator. The government, obviously, the U.S. government can tax 22% of all world output, which is just an unbelievably powerful thing to think about when you get down to it. It can issue the world's risk-free 0% interest-bearing asset. It can determine the rules of its own currency arrangements, meaning that, if the government really wanted to, it could have the Federal Reserve finance the entire deficit. It could, heck, if the government really wanted to, there are even loopholes that would allow it to issue currency directly through the U.S. Treasury. So, these are powers that none of us have, that make the government just a very different entity. And it kind of goes back to, again, thinking in terms of a more pragmatic and operational way. I started to really study, what the institutional design of the U.S. government was. And, when you get into this stuff, you just start to realize, well, this entity is nothing like any other entity in the entire economy. It's not like a private business. It's not like a household. And so the same rules don't necessarily apply. And you have to be sort of careful about some of this stuff, because what I always say with people when I discuss this topic is that really the risk that the U.S. government faces is not that it's going to run out of money. The government can obviously print the currency. The government can issue bonds up the wazoo. And so, the risk of running out of money is not really the concern. Really, the issue with the government is really the real terms of exchange. It's in terms of, will the government create so much money? Will the government print so many government bonds that, it potentially dilutes the output? Or will they implement policy that, somehow entices people to, for instance, sit around all day and do nothing? They just, pay everyone unemployment benefits and nobody needs a job because the government is doing everything. And then you're just you're creating, money and without actually producing any output. And so that's the risk. And, you just have to think of this in terms of a more operational perspective. I think that the idea that the government is running out of money or is becoming bankrupt is just something that just doesn't really apply in a really practical sense. And the U.S. government is somewhat unique in that we're such a large economy that there is some level of exorbitant privilege there. Being able to tax as much output as we can and being able to issue the interest, the risk-free interest-bearing asset these are enormous powers that are very rare they don't apply to every other country. I mean, you look at Greece. Greece is basically running out of money, but again, you have to look at Greece's specific situation. Greece is in a currency arrangement where they can't literally print the money, so they can't even print their own risk-free interest-bearing assets. So, again, you have to be very specific about looking at the institutional design, understanding the specific situation, and really not falling for what turns out to be a lot of, I think, politicized generalizations that they make for great talking points, but when you get down to the really nitty-gritty details of it, they don't make a lot of sense in terms of the way things actually operate or what the realistic outcomes are likely to be.
I think that's one of the things that is probably made your reputation, is that you are a stickler for some of these headlines that are not necessarily grounded in reality. So you're not saying, hey, I think it's fantastic. The government I want them to tax too much, or I want too much money to be printed. You're just saying that technically the U.S. is not going bankrupt and breaking it down. Now, if the government starts to go in a direction where there's too much taxing or there's too much printing of money, that's a whole different issue. But you're trying to come from that headline perspective and get people to tone it down a bit and say, let's take a step back and what is really going on here, and let's be precise about it.
Exactly. I mean, that's the interesting thing, is that I think that you hear, for instance, a lot of conservative commentators, talk about how the U.S. government is going bankrupt, or, we're running out of money, or we can't afford to do this. And really, that's the wrong way to frame the discussion. It's not about whether or not we have the money or whether we can actually afford to do these things. I mean, we can print the bonds, and we could technically issue the currency if you kind of used a loophole or changed the laws or whatever. But that's not the point. The real point is not about running out of money. The point that we should be focusing on is the real terms of exchange again. That, the risk of government spending is that they're going to potentially dilute the output of the private sector, that they, potentially entice people to not do anything, on a daily basis. And again, you get into a whole different debate about that. But from a very technical perspective, it's a different conversation. And if you're precise about it, the same sort of general concerns about being weary of the government and what they're doing, they still apply. They just, if you're going to discuss it, I think it's important to get the technical operational details right, so that you're framing the discussion properly, so that you can really understand what the potential risks are and what maybe the potential solutions are, or what the potential deterrents are.
Fair points. Let me jump into one other myth that I know you've put out there. Now, you consider this a myth. Central banks exist to enrich bankers. Now, that's a little more controversial. I think people just generally would sit back and say, well, that sounds accurate to me because, for example, why does Goldman Sachs and Morgan Stanley still exist, and why was Bear and Lehman Brothers allowed to go under? So it looks like maybe there was some favoritism there, some friends helping friends there, and that makes me feel uneasy. I mean, is there some truth to that? Or talk about the myth first, and then maybe talk about bringing in some of the bailout ideas.
Well, I think that this is just another conversation that I think tends to really run into a lot of just extremist conversation. And when I discuss what the Federal Reserve is and what it does, what all central banks really are, is, again, I try to get back to sort of an operational understanding. And when you look at, for instance, the creation of the Federal Reserve was in, technically 1913, but really what prompted it was the financial crisis in 1906 and 1907. We'd had a series of big bank blowups in the late 1800s and the early 1900s, and the Federal Reserve was modeled after a clearinghouse in New York called the New York Clearinghouse. And this was a place where all of the New York banks would come and they would settle payments overnight, basically, and they would use loan certificates. And the problem with this arrangement was that what would happen in a financial crisis is the banks would all seize up. They would stop trusting each other. And so the loan certificates were no good. They literally wouldn't lend overnight to each other. And when that happens, it's funny with banks. Banks are so central to the way our monetary system works. And the modern day monetary system is it's almost completely run through banks. And when the payment system that operates through these banks, when it stops working, the whole economy stops working. And so in a sort of weird way, we're all dependent on these entities that are private profit-seeking entities that sometimes take enormous risks and sometimes put the entire economy at risk. But we're all dependent on them to maintain this system that operates so that I can go down to the grocery store and buy groceries and that, make sure that my credit or debit card actually settles a payment overnight or whatever. And what happened in 1906 and 1907 was you just had this massive banking blow up where the banks stopped trusting each other. And I think that people kind of started to realize that maybe it makes sense to have an entity that has some national backing that can come in and help avoid this from happening, that will support the banking system in a way that will help payments continue to clear. And I think that the funny thing with quantitative easing and a lot of monetary policy fidgeting with interest rates is that people forget, I think, that the Federal Reserve and a lot of central banks are much more than just interest rate setters or entities that implement quantitative easing. What they really spend most of their time doing is overseeing the banking system and making sure that it's just sort of running smoothly, that the payment system is clearing and little sort of mundane things like that. And so what I tried to get away from with that myth was not that the Fed is not there to help the banks. I mean, we should be very clear. The Federal Reserve was created to help banks. So it is, you could say in a lot of ways, it is definitely there to make sure that the banks don't go out of business, that the banks don't blow up the whole system. But at the same time, I think there's a tendency to sometimes believe that it's a conspiracy theory, that they're only there to help the banks. And I think that it's more balanced than that. I think that the Fed does a lot of things that actually help the average person more than we probably actually understand. And so that was really the focus of that chapter, and trying to bring, again, a more sort of operational understanding to what the Fed does. And don't get me wrong, I've been a big critic of quantitative easing and a lot of the policies. I was a big critic of the bank bailouts and a lot of the things that the Fed does. But when you kind of get down to what the Fed is, and again, looking at the monetary system for what it is rather than what we want it to be, you kind of understand that the Fed is, in the current design of the system where you have these sort of inherently fragile private profit-seeking banks, the Fed is almost a necessary evil. And that's sort of, that is a sort of a disturbing thought to think of, that we need this entity that seems to do, these sort of almost corrupt things in terms of bailing out, banks that made bad decisions and whatnot. But under the current design of the monetary system, I don't know what the other alternative is. Do you let the banks do all of this on their own, as they did in the 1800s and the early 1900s, where we know that the system is susceptible to just these massive blow-ups? Or do you let the whole government deal with it? Do you nationalize banking, and do you let the government manage the payment system? And I think that, in a funny way, those two options are almost worse than what we have. We have sort of this, it's not a clean hybrid system between public and private, but it works, I think, probably better than what some of the alternative is.
It's a fascinating perspective, because it is a perspective, and I can see why your writing and your thought gets traction, because you are breaking it apart in a way that just doesn't get a chance to be broken apart in soundbite society.
Yeah.
It's just hard to do when people, even if you make a lot of media appearances. If you come on and, teleprompter read and hot lady asks you a question, you've only got so much time. You really can't elaborate what you just said. But what you just said, even my biggest libertarian conspiracy friends that I have would say, well, yeah, what Cullen just said is accurate. What else can you do?
That's the most frustrating thing about doing these sort of short media hits is it's impossible to actually say anything that's really relevant. People give media commentators a lot of flack, but it is so hard to get on there and you have 90 seconds to say something relevant. And, when you're talking about topics like this, it's just impossible. So that's why,
Yeah.
I mean, this is such a superior, way to actually go about, spreading the message. And again, it's so important. This is why a lot of the financial media is sort of destructive, is because a lot of it is it's just sound bites. They're just looking for something to get people's attention, sort of a fire starter, rather than, I love the whole educational aspect of blogging, because it provides a platform where you can really begin to hash out things and really get into the details and have a really rational discussion with people that disagree. And, a lot of your listeners are going to disagree with things that I say, but that's part of the cool part, is that we can all sort of have this discussion and be rational about it, not get angry and get political about it, and hopefully sort of learn and build on ideas and really, educate one another and become better informed about the way that all this stuff works, because it is really damn confusing.
Okay, let me shift big time gears, because you shift gears in your book a lot. I want to go to an interesting individual that you put into your book and some of her work. And by the way, I reached out to her based on reading Pragmatic Capitalism. I reached out to her in the last 24 hours and asked her to be on my podcast. And this is Laurie Santos at Yale. And basically, in the behavioral finance perspective, she's working with monkeys, and she's looking at the evolutionary origins of our minds by comparing the cognitive abilities of humans and non-humans, humans and monkeys. How did that end up becoming part of Pragmatic Capitalism?
Yeah, Laurie, so I reached out to her a few years ago. I think she gave an awesome TED Talk on this in 2011, and I think it's called A Monkey Economy as Irrational as Ours. And it was really cool. What she did was she actually did some studies that were similar to studies that Daniel Kahneman and Andrew Lowe have done, in terms of trying to figure out sort of where we're biased and where we're not. And what Laurie discovered was, she found that when she taught monkeys how to interact with money, that they ended up making a lot of the same sort of irrational decisions that human beings make. And that, for instance, when one of the experiments she did was, she found that when monkeys have lost something, they actually are more susceptible to taking more risk. And so this applies to the markets in a way that we all probably know. I mean, anyone who has ever lost money in, a stock, you buy GE at $30 and it drops to 25, and you think to yourself, well, God, I had it at 30. Now it's at 25. If it just gets back to 30, I'll sell it, and I will have broken even, because I'll be back to where I was. And what Laurie found was that the monkeys, when they lose something, they're willing to take more risk. They'll double down, or they'll do things that are irrational, that really make no sense. The example that I always use is, I don't know if you've ever been to Las Vegas, but if you've ever been to Vegas, it's the guy who is sitting there, who is burning through cash, just going back to the ATM. And it is completely irrational, but the thought process is, well, I'll take out another $500 and then I'll triple my money. I'll get back to break even. I'll go back up to the room and I'll just call it quits. But you keep going back to the well there. You keep going back to the ATM, and you keep making these irrational decisions that actually, they multiply the amount of risk we're taking by a huge amount, when really the right decision to make at that point is to establish a set of rules. You have to go in with an established set of principles that are going to guide how you're going to play the games. And if you deviate from those plans and you allow your sort of emotional biases to inhibit what your plan is, it ends up resulting in a huge amount of unnecessary risk. And so Laurie's studies did just a huge amount of work on these monkeys and found that the monkeys are really no different than we are, which was totally fascinating, because, we think of ourselves as these really rational, intelligent creatures, but we're susceptible to so many biases that we don't even consider, because we haven't really taken the time to fully understand them.
So as you talk about Laurie and her monkey work, and we start talking about risk, I want to move into the subject of an interesting subject for you to break apart There's some myths involved. There's also some tremendous wisdom. And you quote Warren Buffett in the book. You say, taking the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain, expected value. And this is the way. We want to have these like imaginary visions of Warren Buffett as this folksy guy that, is grabbing an ice cream, and maybe he's even positioned as not being as intelligent as he is, perhaps. But everything he does, and there's many other traders and investors around the world that are using similar types of thought processes, but it's all about bringing risk down to something they can measure.
Right. Probably my favorite myth in the book is the myth that we can all become Warren Buffett. And I think that Buffett is such an interesting investor when you look at what he's done. And again, one of the first things I ever did when I got into the business of the financial markets was I printed out all of Buffett's annual letters. And I printed up all of his old Buffett partnership letters, not just the Berkshire Hathaway letters. The partnership letters are almost more educational and more interesting than the Berkshire letters. But what you found was that Buffett is this incredibly sophisticated guy who is running a strategy that is nothing like the sort of folksy, frugal, friendly guy that we all hear about. This is a guy who is running what I essentially think is a huge multi-strategy hedge fund that he's basically built an option writing house through the insurance business. He has built a distressed debt firm through some of his operations in terms of where he goes in. And I mean, the purchases that he's most famous for, like Geico and American Express, were essentially distressed debt plays. And you don't think of Buffett like that. You don't think of Buffett as being this sort of hedge fund manager who engages in option writing or distressed debt or really, very sophisticated risk-focused strategies. But that's what Buffett has built. And, he's come to sort of be known as this value investor. And I think that the media has done a pretty substantial amount of harm in terms of depicting him like that, because it's created the myth that anyone can do what Buffett's done. And it dumbs it down. It dumbs his strategy down to such a degree that I think that you end up with a lot of people who they open up a brokerage account and they think that, I just need to look at PE ratios and find firms with a wide mode and, implement this sort of mundane value strategy. And as long as I buy and hold it, I'll be fine. And that's not at all what Buffett is doing. I mean, the deals that Buffett gets, the strategies he's implementing, even the different asset classes he's owned over the years through derivatives and bonds and corporate bonds and warrants. I mean, the deal that he got, for instance, from General Electric and Goldman Sachs back in 2009, I think it was, during the sort of the bottom of the financial crisis there, was a sort of deal that nobody can get. I mean, I think he got 10% paying warrants or something from both firms with, obviously the option to convert to equity later. I mean, these were deals that are, from a risk perspective, are just masterful in a way that are not often, I think, correctly described by the mainstream media. And that's the thing that I think Buffett sort of, he downplays it himself. I think he depicts himself as sort of this simple guy, but really what he's doing is so much more sophisticated, so much more complex, so much more risk focused than a lot of people that think. And I think that that's a really destructive way to understand what he does, because he's such a famous guy. He's sort of like he's the Michael Jordan of investing. And, people are trying to shoot the basketball like the equivalent of Michael Jordan would, but Michael Jordan has talents and thought processes and, athletic abilities that none of us can replicate. And Buffett is really similar in terms of the way he has built Berkshire. So I think it's, again, kind of going back to understanding the operation that he's running there. It's just really important to get it right in terms of understanding what he's really doing, so that you don't go into it thinking that you can replicate something that probably is, almost certainly not replicable through, your Charles Schwab account or something like that.
And again, I think the audience can see the through line here in your work, where you're not trying to necessarily give a value judgment on the operation of the Fed or the complete operation of Warren Buffett. I think what you clearly enjoy is seeing that a good portion of media, writers, analysts, etc., again, keep this all at the soundbite level. And I guess you see your opportunities to say, hold on. Let's talk about how these things really work. I'm not necessarily trying to tell you what you should do or this or that, but let's put the value judgments aside. Let's talk about how things operate.
Right. I mean, and I think it's just a much more valuable way to go about, building a really practical framework for benefiting from the world we live in. When I first started my website back in 08 and 09, I knew exactly what worked. I mean, if you wrote an article about gold or how the market was going to crash or how, the Fed was a big conspiracy theory or anything that was sort of, a political fire starter, it was instant traction. It gained a huge amount of attention, huge amount of comments. And that was sort of that would have been the really easy path for me to take in terms of building up an audience and keeping people coming back. And I made a very conscious decision back during this period. I said, I'm not going to do that. I'm going to try to describe things as they are and give people a more sort of realistic, hopefully, perspective of what is really going on. And, I think that it took me a lot longer probably to build the audience and to gain the traction that I could have in the short term. But I think that people have come to appreciate that to some degree, because I think that at the end of the day, people don't, they want to be told something that will make them comforting, but they don't want to be told something that could potentially make them worse off. And I think that that's the value in really educating people, that you can really empower people to take more control. You don't have to look at, CNBC or Bloomberg and rely on some talking head, figure out whether it's a good idea to buy gold for 100% allocation of your portfolio or something. You can look at this from a very practical perspective and understand, where gold and commodities and things like that fit into sort of the capital structure and a capitalist economy, and make a really practical decision about how you're going to go about potentially benefiting from owning an asset class like that. And that was really the focus of what I tried to do.
For those people out there that perhaps don't have your understanding of the intricacies of our banking system, and I sure as hell don't. It's taken a lot of work for you to get there. I know you've worked hard to figure it all out, and
it's all front. I probably don't know.
But look, let's talk about, for example, those folks that have they've talked about gold and buy gold, and I sometimes think it's a shorthand for those folks that are concerned. And I ask you, is it fair for a large part of the population to be concerned about what might happen next, given that in the last 15 years, there's been two 50% downdrafts in the S&P, and it looks like, as far as we can see into the future, the idea of interest income has been removed off the playing field. Now, from a pragmatic standpoint, I think your argument would be, well, yeah, okay, Mike, there's no interest income. We got to deal with what the hand we've been dealt right now. But for those people out there that are saying, God, well, we're at all-time highs on equities. I mean, we've seen, where interest rates are at zero. I mean, are we in the middle of another bubble? It's fair, though, for people to feel concerned after the last 15 years of boom, burst, boom, burst. Isn't it a fair stance for people to be concerned?
I think 100%. I mean, one of the things that I discuss in the book that it really drives me crazy, how I think that there's a huge portion of the investment community that has sort of, I think, fallen excessively for this sort of idea of passive investing and stocks for the long run. I discussed this in some detail about Jeremy Siegel's book, and how, destructive I think it can be to build this sort of almost naively optimistic view of the economy. And I think that it's important that people be optimistic, because I think that in the long run, I am an optimist. I mean, I think that it's somewhat naive, I think, to bet against human innovation over very long periods of time. But at the same time, you have to embed this understanding that at the end of the day, we're very rational creatures who we exist in this very dynamic and complex system that is extremely susceptible to chaotic turbulence. And that is inevitable. And so, well, you want to maintain this sort of, I think, optimistic perspective over the long term. It makes complete sense to embed some sort of hedging mechanism in the meantime that really protects your savings and your portfolio from, these potentially extremely turbulent periods like 2008 or, 2002 or, the 1987 period. And, what we're really getting at is getting away from the idea that you can just buy a portfolio of stocks and hold it for the long term and sort of make a naive bet on the potential optimistic outcome of the United States or any economy. I mean, I think that it makes a lot of sense to be optimistic, but to be, I think, somewhat moderate in your optimism, and almost hedge your bet against your optimism just in case. The way that I sort of think of it is, you want to buy a house maybe, so you buy a financial asset like that, but it makes a lot of sense to own insurance against it. So maybe you write some puts or calls against your portfolio or something, or you implement different sorts of non-correlated strategies that help reduce the variance in a portfolio, or, buying commodities. Commodities tend to be non-correlated to a larger degree. So, there are times where commodities can act as good hedges. And the example I use in the book actually that applies perfectly to this is the way that a lot of businesses operate. A lot of businesses, for instance, take an airline. An airline, at the end of the day, they just shuttle people around. They have no real business in buying oil and, petroleum, but they're dependent on it, obviously, to be able to shuttle their passengers around. But what a lot of these companies do is they go into the commodities markets and they will hedge their business. And what they're trying to do is they're not trying to necessarily trade or make big bucks from, buying commodities on these exchanges. What they're really doing is they're hedging their operations so that they can create predictability. And I think that sort of a concept applies to portfolio management to a large degree. So I hate the whole concept of passive versus active investing, because I think that what it does is it creates this sort of myth that you can buy and hold stocks or something like that, and that you just have to be able to ride out the turbulence. And I don't think that our financial lives work like that. Our financial lives are not made up of sort of a start and go or start and stop period. You don't ride the green line to the finish line and get off and buy an island or something. You have big expenses along the way that require planning and stability and, a really somewhat stable approach. And so I think that it makes a lot of sense to embed a multi-strategic portfolio approach that helps to hedge and reduce the variance along the way, and sort of get away from the myth that you have to, beat Warren Buffett or beat the market every year just to survive. You really don't. Our financial goals are totally different than, having to beat the market every year.
It reminds me as you talk, and I start to see the similarity between very different strategies perhaps, but similarity between some of the writing in my world. And I'm very careful that, if I have 5 books out on a certain subject, a certain style of trading, if I'm going to go ahead and I'm going to offer an opinion and say, well, I don't like the idea that interest rates are set to 0 for the foreseeable future. I don't like the idea that Goldman Sachs is bailed out. But from a trading standpoint, a trading strategy standpoint, those 2 thoughts on one side of my brain have absolutely nothing to do with the my analysis, or executing to try and make money. Meaning it becomes almost like, Trivial Pursuit or something, but it doesn't add to making the proper decision within the framework in which you're operating. And I think people need to be careful about that. And I think that's, if people are listening carefully, that's what you're really trying to get across, isn't it?
Yeah, exactly. I mean, the sort of cliche example of this is don't fight the Fed. The people have been talking about how interest rates are going to rise for the last 5 years. God, in Japan, I mean, people have been having this discussion for so long that it's become called the Widowmaker trade. Again, it all sort of goes back to understanding, how the Federal Reserve operates, how they really determine the interest rate on overnight loans, and, the specific type of environment we're in. Obviously, you can't completely rely on understanding just operations. There's got to be some amount of prediction that goes into a lot of this analysis, because, if the economy started to boom or something like that, or wages started to really skyrocket, the Fed would respond, and the Fed would be reactive. And the Fed often is a reactive entity, which is one of their biggest weaknesses. But at the same time, I think that understanding the operational side of things really helps in terms of being able to digest the current environment we're in and being able to apply that to, again, going back to sort of probabilities. A lot of this is just we don't deal in certainties, we deal in probabilities. And that's really an essential understanding of building a portfolio that is likely to succeed. None of us know exactly what's going to happen. And so we have to just sort of construct a framework that is going to, I think, generate a high probability of establishing, a high likelihood of success. And that's sort of the approach that I've taken through, really understanding the world for what it is and sort of constructing a framework that allows me to sort of digest these really complex topics in a way that will improve my likelihood of being right in the future. And the reason why you need those hedges in there, and you need, lots of moving parts in a strategy, I think, is because you have to know that you're going to be wrong. In fact, you almost rely on being wrong to some degree in some portions of the portfolios, I think, because that's what creates a lot of the non-correlation. It's what creates, hopefully, more winners over the long term than losers.
Cullen, the new book is Pragmatic Capitalism. It is everywhere. It is on Amazon. It's the main place to buy it for just about everybody these days. PragCap, PragCap.com. People can follow you on your daily journey. What else should we tell them?
That's about it. I've probably spoken too much already. So
did I wear you out?
No. Oh God, I could keep going for probably hours. I mean, you've gone through the book. There's so many topics in there that I could probably blabber for days about it. But most of your readers are probably listeners are probably starting to fall asleep by now. So I don't want to put everyone to sleep.
It did strike me though. It really is. You come at it from the perspective of like, you're not trying to say, hey, this is all optimal how I would design it, but you're kind of saying this is the hand we've been dealt. So deal with the hand we've been dealt.
Yeah, I mean, I think that that's just a really important thing. Unfortunately, I think that the world of money is it's just a very emotional thing, and it's intertwined with politics, and it influences all of us in a lot of positive and a lot of negative ways. And so it's a really controversial topic, and I think that it's important to not fall too much for the sort of hope-based thinking that, thinking in terms of what you want the world to be. You might want the world to be back on a gold standard, or you might want the Federal Reserve to not exist, or you might want the stock market to crash, or you might want corporate America to not be doing as well as they're doing. But none of that really matters in any practical sense. It's, as everyone likes to say, hope is not a strategy, and that applies to everything that we're discussing here in terms of just understanding things and then being able to apply it. And so, again, it's just all about, in my view, building a really sort of fact-based, operational-based understanding of the way that the monetary system and the economy and the financial world works, and then trying to apply that in a way that might benefit us. And that could mean lots of different things. And I think that it's important to sort of, build that approach in a macro perspective that covers lots of different perspectives and understands that we're biased, we're going to make mistakes, and that we can, through sort of understanding all of this stuff, we can actually improve our performance because of a superior understanding.
Hey, so when does the location independent Cullen start? 6 months Tokyo, 6 months Singapore. When does this start? You can be anywhere.
Oh God, I told you I'm still following your lead. I always have been. So I've been in Tahoe for the last 3 weeks. So
Okay.
I'm like the baby Michael Covel at this point. So
Yeah. It is true, but it is true. You can be anywhere. I mean, that's a great feeling. You could be anywhere.
I can. I don't know. You somehow managed to convince yourself to leave San Diego. I have not gotten to that point where I can be away from the beach and the sun there for too long. So
San Diego does have some fantastic weather. I would have to say that is one of my biggest misses is being able to go for a jog or something in San Diego. And going for a jog in San Diego or a run in San Diego, I don't know if that can be beat anywhere in the world.
Yeah, I'm a big weather guy, so I don't know. I mean, having grown up in DC and stuff, I think back at the cold weathers and the rainy days, and it would be hard to pull me out of San Diego. But yeah. I don't know. You're not in a bad part of the world, so maybe I'll hunt you down and I might show up on your doorstep one night.
Hey, listen, it was good chatting today. We will have to talk again in the future, and I think my audience will enjoy this perspective.
Absolutely, Mike. Thanks for having me on. I appreciate it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.